This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast. My guest on the show today is Shanoop Kothari, co-CEO and CFO of LuxUrban Hotels Inc. It's a publicly traded company. The symbol is LUXH on NASDAQ. LuxUrban Hotels Inc. utilizes a long-term lease asset-light business model to acquire and manage a growing portfolio of short-term rental properties in major metropolitan cities. The company's future growth focuses primarily on seeking to create win-win opportunities for owners of dislocated hotels, including those impacted by COVID-19 travel restrictions, while providing favorable operating margins. The LuxUrban business model is a little different than your traditional hotel operator. The nuance, as Shanoop describes in our interview today, is that they enter master leases with hotel owners where they have control of the asset, just don't own the asset. We dive deeper into what this means, as well as why the company decided to focus solely on the hotel business, the nature of LuxUrban's relationship with Windom, why they chose them over, say, a Booking.com for just the reseller aspect of the business, whether it's getting harder or easier to get more leases. In essence, is it getting easier or harder to scale the business? And Shanoop's 3 to 5 year vision for the company. With that, please enjoy my conversation with Shanoop Kothari, co-CEO and CFO of LuxUrban Hotels. Shanoop, thank you for joining me today. How are you doing?
I'm good. Thank you for having me.
Absolutely. It's great to have you. So we were introduced. Listen, I've been following the LuxUrban name for a while. I think you've showed up in our index, or the Planet MicroCap index, a couple quarters in 2023. And just for reference, everyone, we're recording this on I think was today Thursday. Yeah, Thursday, December 28th, 2023. And I was introduced to the company, or to you, from Scott Weiss and Matt Williams. So guys, appreciate it. And so let's dig in. So my first question that I ask everybody on here, and you're no different, I'm going to ask you the same thing, is can you start us off with that one-line description that best describes LuxUrban?
Yeah, so we're a hotel company that is taking advantage of the dislocation in commercial real estate.
Beautiful. That's a great one line to start everything off. So let's take a look back at LuxUrban Hotels history. You know, when was the company founded, and what was the original thesis for the founding?
Yeah, so 2017, the original founding of the business was not to be a public company. Was supposed to be a privately owned business that was primarily focused on apartment rentals. And then in 2021, late 2021, we pivoted, started the pivot to hotels, which was fully completed at the end of 2022, shortly after our initial public offering in August of 2022.
Very good. So, I mean, what was the main problem that you guys were looking to solve back in 2017, and then with the pivot in late 2021?
Yeah, so profitable apartment rental business, 2017, 2018, 2019. As we all recall, COVID hit in March of 2020, and anybody in the hospitality space struggled during that period. No difference for LuxUrban, and that struggle continued through 2021 when things started getting a little bit better. At that point, there was an opportunity to enter into, instead of decentralized apartments, opportunity to enter into entire hotel operations. Those were primarily shuttered as a result of COVID, but the economics were phenomenal from two sides. One is the entry price was, you're coming in at cyclical low, so the entry price was good, it was attractive, and then on the other side, the economies of scale of going from decentralized apartments to more consolidated operations in hotel, with the expertise of being able to manage it, was really the fundamental shift in terms of how the company viewed the opportunities going forward. That was sort of in the summer of 2021. It continued to the end of 2021, early 2022, when we entered into a large New York hotel. It was the Blakely Hotel, 117 rooms, about 3 blocks from the park. High quality, 3.5-star property, iconic, sort of old world New York City. At that point, we really realized that, look, the opportunity set here that is perishable is to enter into these shuttered hotel properties and really grow with scale. So that continued through 2022. We went public in August of 2022. We were straddling sort of both businesses. And then we made the complete decision in late 2022 to exit the apartment rental business and be fully the hotel operations side. So we signed up a number of other large properties in 2022, one of being the Herald Square, which was formerly Marriott Herald Square in New York City, right across from Macy's. The other one was the W Downtown, which we call 123 Washington. So we were on our way for that, and we just saw that the economics are significantly greater, as well as the legacy apartment rental operations was really more of a distraction at that point, management distraction. So we exited that in 2022. Since then, we've been off to the races.
So what's interesting about the company, and like in talking with guys like Scott and Matt, and then doing some due diligence, you think when you first think of LuxUrban Hotel, you're like, okay, it's a hotel company, but it's really not. It's really more of a services company where you own leases on these hotels, and then you're helping these hotels where your value comes in. Your value prop is filling out the hotels and getting those rooms rented, I don't know what the proper term, I guess, rented, right?
Yeah.
So, I mean, am I missing something in terms, because coming out of COVID, there wasn't as much of a demand for travel and everything. All these hotels are probably at risk of going under, and they're like, all right, well, maybe we can partner with groups like a LuxUrban or other groups out there so that we can, they can go out and be a reseller of our rooms in order to get us that capacity or at a place where it becomes economic for us to keep the doors open. Am I missing something? Please let me know. I might be.
Yeah, I think you're not missing something. It's just the business model is a little different than a traditional hotel operator, right? So from the hotel operation side, we do everything else a hotel owner does who operates or manages the property themselves, right? We list the available units, online. We manage the reservations, we check in the guests, we clean the rooms, rinse, repeat over and over again, right? We do this, we check in thousands of guests a day. We do this, every day. We have operational calls going through, typical with any sort of hospitality, people-oriented business. There's always issues associated to, an air conditioner down, water heater down, a roof, leaked in a major storm, et cetera, et cetera. The difference, the nuance between us and traditional hotel operators is as you mentioned, we enter into a long-term triple net master lease where we control the asset for a long period of time. Our leases average around 20 years on a weighted average basis. We're entering into 20 plus 10 sort of our normal core now. So call it 30 years. So we're going to drag that weighted average up over time from, 18 to 20 to 20 to 22 and so on and so forth. But we are in control of the asset. We just don't have ownership of the asset. So as opposed to a capital heavy program where you're putting down a large portion of you're putting a large down payment down, and then you're managing debt service. We're eliminating that whole portion of the large portion down, and we're really just sizing our business to debt service. So initially I mentioned that we were coming out of shuttered properties in COVID. And that's when we went public, we were still working through a bunch of shuttered properties. But what really happened, and post COVID, that no one really foresaw, but we kind of had a sense something was going to happen. We didn't really, sometimes you're good, sometimes you're lucky. We couldn't put our finger on it. what ended up happening with the precipitous rise of interest rates is you've got this whole refinance bubble that's occurring right now. So the dislocation in commercial real estate is people coming off of really perpetual 3% interest rates now to 8 to 12% on a refinance. And so you've got this whole capital structure dislocation that's occurred in the hotel space. And then, you add a couple other factors to it. One is asset values are down, right? So pre-COVID, an asset that might have been worth 100 million might be worth 70, 60, 70, 80 million now. So if you look at the structure of the capital structure of the business, the equity value is effectively either gone or almost gone, or sometimes undervalued, underwater. And then, owner operated, managed, and franchised assets, where you're dealing with variable cash flow, right? When an owner operates it, they're going to get, positive cash flow in 1 month, neutral cash flow the next month, negative cash flow the third, so on and so forth. Those sort of situations are not financeable anymore through banks. So there is no financing market associated to it. And why is that the case? Typical with any sort of major economic issue like COVID or like 9/11, banks changed their rules based on what happened, and banks are now no longer interested in a variable cash flow, supporting variable cash flow stream. Whereas what we come in is we provide a fixed cash flow, triple net lease. It is financeable with the bank. We take the risk associated to something bad happening, macroeconomic issue or a health issue like a COVID. We take that risk. We provide a corporate guarantee. It's financeable. That's sort of the nature of the acquisition side. But on the upside basis, we take full control of the asset. We get all the upside associated to it. We're making money, at these levels now. We think that, these are still depressed, even though hospitality has been resilient. We still don't have much in terms of business travel. We still don't have, Asian travel back to where it was. China's not traveling at all. So we've got a bunch of, factors associated to the upside. So we call this period right now, a land grab, where we want to continue to grow at a very healthy rate to, increase our unit count at historic lows and what we think are historic lows. And then we'll reap the rewards once that we thaw out of some of the macroeconomic issues that are going on now.
Absolutely. And thank you for all that clarification as well, to get a better picture of the business itself. And just because I think the main thing I thought when I first looked at it, I was like, well, why are the hotel owners, what's the real value prop that LuxUrban brings to the table? Right. And it was more coming from a place of, because like one of my close friends for the last 15 years, his dad's in, he's a hotel management business. Right. And so I was like, I was like, well, what? I know he doesn't do everything that I think LuxUrban is saying they're doing, but I'm still trying, like, what's the main difference? Right. And that's what that for me was the main question I had going in.
Yeah. But, look, we're a hotel operator, and I think everyone really focuses on the acquisition side, right? Which is really the engine of the growth. It's going to be, how we get from, where we are in terms of valuation to 2x, 3x, 4x, 10x, right? And that's the fundamental core. But what I don't want to lose sight of is we're a hotel operator, and we're really good at it, right? We have, we're a privately funded business pre-IPO. We have very significant management ownership. Management, has invested in the business as recently as a month or two ago, right? We're very bullish on the opportunity, but we operate very efficiently. I mean, do we make mistakes? Absolutely. Do we learn from things we've done poorly in the past? Of course. But we're very good at revenue management, which is something that in a very decentralized hotel business, you have GMs who are responsible for smooth operations that are doing revenue management. We have a whole team of folks, right? Some of which are, data scientists that are, scraping a lot of different data in order to fill perishable rooms. We do a very good job of that. And then on the hotel operations side, we're very scrappy. We reduce cost centers that, don't make money, right? When you don't have business travel return, we eliminate conference centers. We don't need restaurants, right? Especially in large metropolitan cities, which is where we operate, right? We're in 5 major cities. looking to expand to two more. But you don't need food service, right? And let's face it, right? When you travel, you aren't looking forward to the hotel room service or the hotel, restaurant. That's not where people focus in on. It's convenience, but when you're primarily leisure travel, and price dictates, where the value is. That's a very, very big loss leader for properties now. So we're very nimble at the operations side. We're very good at the operations side with number of histories of taking in incumbent professional managers exceeding their numbers and within their annual numbers within 3 or 4 months. We've got GMs we've hired that work for in incumbent management companies that have come to me and told me that, wow, you guys operate much more efficiently than we've ever seen before in our career, right? So I don't want to lose sight of that. But look, the engine, for the purpose of this call, our ability to acquire, our ability to integrate, our ability to grow, which we've either doubled or tripled each year since inception, this year being a tripling, next year being, again, a doubling or tripling, how we look at it. That's the engine for, fueling the growth in the stock and, the purpose of, really this audience.
Absolutely. So, actually along these lines, another question I had for you was, would you say it's getting harder or easier to get more leases? And is it getting easier or harder to scale this business model now that COVID-19 travel restrictions are gone?
So COVID separately, we are, the hospitality industry, once, the COVID overhang restrictions, fear has lifted, the hospitality industry continues to be resilient, right? Even with, earlier this year and mid-year, while the recession fears, that hasn't been a factor. Where you would see a potential, a potential opportunity where there could be, an increase in terms of the benefits is overall room rates, but that's a factor of, think about like the airline model. If you can sell every seat, maybe 20% more than the seats, then you can charge a lot more for that entire block of, entire 200 seat airline. If you can't sell every seat and you can only sell 80%, well, you got to discount it to fill the 20. And, that's sort of the factor where we're in now, right? Without the business travel and China travel, in Asia and in Eastern Europe, it's slightly, I wouldn't say depressed, but there's, upside opportunity. Coming out of COVID, that overhang, is no longer there. There was some of that overhang. To directly answer your question on the acquisition side, the scale has helped. We're much larger than we were when we added, some of the first landmark properties. We've got experience in how to do that. We've got a SWAT team that comes in, takes over the operations, that integrates it. So we're very efficient in that regard. We've also learned from our mistakes. And then overall, the acquisition pipeline continues to stay robust because, there isn't a lot of alternatives, for landlords coming on to refinance, right? So, one of your follow-up questions is probably going to be, is there anybody else doing this? Well, not what we're doing, right? There's alternatives to what comes in terms of refinance dislocation, right? So we just talked about capital structure dislocation at the asset side, but not on the operating side. What are the alternatives? The alternatives are for landlords to put more money in, to cross-collateralize other assets, to bring in a partner, right? An equity partner that limits their upside on the building. So there's other alternatives, but there isn't an alternative like us. That's another alternative like us. And in a lot of cases, we're the best solution, right? They don't have to come out of pocket. They can keep the asset. They have the ability to refinance in a few years when things probably normalize. Dislocation's over.
Got it.
Excuse me.
Oh, no worries. So another question that I had for you was about LuxUrban's relationship with Windom. Can you describe the nature of this relationship? Why did Windom choose LuxUrban over, say, a Booking.com as a reseller of rooms? And let's go with those two questions, and I'll follow from there.
Yeah. So Windom effectively competes with Booking, right? So Booking is a platform that allows you to book, any property, right? Primarily any property on the planet, right? Or an Expedia, Travelocity, et cetera, right? Windom, no different than, Marriott, Hilton, Hyatt, et cetera, Choice even, has their own, sort of booking engine, OTA, online travel agent, where you go direct to the site. There's assurances that you're getting the best price for those properties listed, which are branded Windom. And then you get the benefits, right? You get the benefits associated to being a rewards member. You get accumulation of points. You get status. You get promotions, et cetera, right? Upgrades, so on and so forth. So the relationship we have with Windom, and to your question is why Windom come to us? Look, it's their business to grow through additional franchisees, right? We're a franchisee of Windom, no different than their other 7,000 franchisees. We negotiate our deal, independently. We're not the largest, but we're one of the larger ones, probably getting, if we continue to grow, we have an opportunity of being the largest, right? And they see that. And so, they provide us the support, corporate infrastructure, systems, their online travel agency, access to the reward members. And so again, we're no different than any other franchisee. We think we have a better deal. We have to be very careful on what are our specifics on our deal, because it's sensitive to them. But we think we have a better deal based on, the size of our portfolio as well as our growth rates. And, again, we get all those benefits. So let's go through a couple specific benefits, right? So they've got, inherent systems that are, scalable, on a much larger scale. So they've got Opera and Oracle. We integrate with that. We can communicate with cross-platform. We can communicate with them. We have access to the reward members through those platforms. So it immediately allows us, access to 100 million plus members, right? The largest reward program on the planet. They provide us support with regard to online travel agency. So you can book off of their website, right? Again, no different than booking off of Booking or Expedia, but you've got a captive audience of reward members that are coming onto their site, and that is economically a lot cheaper than paying fees associated to the other OTAs, right? So we get a margin improvement associated. That could be in the neighborhood, how we calculate it, 4 to 5% over a course of the next few quarters, right? So it's meaningful, right? Straight to the bottom line. And then finally, they provide us, key money, which is, development incentive dollars, which is, as long as we perform on the franchise agreement, it's, lack of better terms, a gift, which they recoup that through their fees over the course of the franchise term of the franchise agreement. But that allows us, that cash is fungible. That allows us to put down for security deposits that we enter into to get access to the property. And, the way it's structured now, it's roughly about the level of the security deposit. So we have a sort of synthetic financing source associated with the partnership we've developed with Windom. And it's a win-win situation, right? It's a very good deal for them, and it's a very good deal for us, which means that, we're both doing something right.
Absolutely. So, I mean, what in your opinion would you say is the company's main moat, that main competitive advantage that might stop some other people that are also in real estate that recognize the same thing and be like, oh, we could add all these additional services as a hotel management team, and we can go in on the operation. I'd love to hear more there.
Yeah. So we're doing this in scale, right? Could someone do this in one property? Yeah, they could, but they've got to understand the nuances associated to revenue management, which is, the legacy business, built the revenue management tools, and they slid into the hotel side of things, right? So, we've got, 7, years of experience, right? 6, 7 years of experience on revenue management. We didn't start this a year and a half ago when we entered into the hotels. Not only that, the revenue management on decentralized apartments is much more difficult, right? So we're taking an operation that's much more difficult, into something much more, much more targeted in terms of the audience, right? So it's a little bit easier with regard to that. We distribute over 100 channels worldwide, right? So there are certain instances where, a certain demographic, maybe there's, Colombian, Remembrance Week in New York City, that you can draw in additional guests through that channel. And channels are very specific jurisdictions, right? So you go to South America, there's different, they use different channels than we use here, and so on and so forth for Asia as well. And so then incumbent would have to, or a new entrant would have to come in, be able to do revenue management like we do. And we don't, we have found that most hotels, even professionally managed, leave it to the GM who's also responsible for hotel operations. We separate that ask and we deal with it as a portfolio, right? So if you came to me and said, I need 100 rooms in New York, which would be very difficult right now, I could be like, yeah, I get you in 3 different properties within 3 or 4 different blocks. We can satisfy that. Others can't do that, right? You'd have to have enough scale to make sophisticated landlords, comfortable with, handing over their asset to you, right? Now, how did we get into the business? Well, we were in a period of massive dislocation with the shuttered properties. We built our base with that, right? They had no alternative, right? What else could they do outside of just, deal with a vacant asset? So we were able to build our base during a period of dislocation, which, new entrant would have difficulty convincing a landlord that they're going to be good stewards of their assets. You'd have to have a relationship with the union, especially in New York City, which is always challenging, right? There's pros and cons to that. And then, oh, by the way, we've got this, partner that's the largest franchisee on the planet named Windom that's also behind us, supportive. And again, very, very lucrative partnership for both sides.
Absolutely. So, in going through the company's most recent financials and everything there, so I'm curious, what gets you to the point where the company is now, how many rooms do you have to have under management to get to break even and then ultimately free cash?
Well, so we are cash flow positive, right? So last quarter we had GAAP net income. We had, $8.4 million of EBITDA. Our year-to-date EBITDA margins are 24%. We think that normalized, it's crazy as it sounds, we think we get above 30% in terms of EBITDA margins. So we're generating cash, but we're reinvesting it back into the business, right?
I was focused on the 9 months. That's why, because the 9 months it showed the loss. That's why.
Yeah, and then there's some non-cash charges in the 9 months, but for the quarter, we specifically wanted a clean quarter because there's some legacy issues we needed to solve. They're non-cash related. They're more accounting. So we did that, in Q2, but in Q3 we showed the real strength of the business, which is a profitable business, GAAP net income. We believe 2024 will have 4 consecutive quarters of very clean GAAP net income as well. As we've worked through legacy issues associated to the business, we've paid off our senior debt. We've had some revenue share agreements tied to that. We worked through with resolving those, with stock versus cash payments in the future. I think from a shareholder perspective, that was a wise decision to accelerate free cash flow in the future through the issuance of stock. And so we've made a number of moves. We've worked really hard from the IPO to get to this point where we've got scale, we've got a clean balance sheet, we've got momentum in terms of the opportunity set out there, the partnership with Windom, and we're really looking forward to 2024, right? And so 2024 is laying out now to be really an opportunity to go from, we'll end somewhere over the next month or two between 2,000 to 3,000 units. We're over 2,000, but call it 2,500 to 3,000 units. We've got an opportunity to take that, call it 25 to 3,000 units and double that over, what we think our internal stretch goal is to get that by the summertime to get 6,000. So call it a doubling. and then 9 to 12,000 between the end of the year, right? And so a 2 to 3 times growth for the year, maybe 2.5 to 3 times growth for the year. Again, that sounds crazy, but that's what we've done every year since inception. Last year was a tripling of the business. So actually, last year, from a unit count perspective, was almost a quadrupling of the business. So look, this isn't, we're not talking about a hit rate or eyeballs on a screen or selling product, more of a product. We're talking about simple math, which is adding unit counts. We're very good at forecasting what the occupancy is, what the ADRs are. Occupancy and ADR combined is RevPAR. We can tell you that if we get to a certain level, we will triple, quadruple revenues associated with the business, and it's really just the acquisition, right? There's no complexity beyond that.
Absolutely. So along those lines, and thank you for the clarification. Like I said, I looked at the 9-month and not the most recent quarter, so yeah. Appreciate the correction. But going along those lines, in order to reach some of these goals, how, in the path to maintain this profitability, how do you still maintain it while still focused on growth?
Yeah, so we're very disciplined. We started off as a private company with no intentions of being public. We weren't ever structured in a way of, I think a lot of the market was focused on, build it, and then you will get to a stage of profitability, right? Cash flow profitability, or free cash flow, maybe not GAAP, but free cash flow, right? And everybody took, to really the, let's call it the Tesla or the Amazon model, which is, we'll get there, right, with the scale, right? Obviously, these are unicorns, very successful companies that, trailblazed and were able to do it. But, the music stopped with that, right? The capital availability stopped with that. This business was never built to do that. It was always to be a private business, to be profitable from the get-go. Everything underwritten was done. It's profitable now, and it only gets better because of XYZ, which is the way that we operate today, right? So we're underwriting to the same criteria we did, over a year ago. We're very disciplined on the underwriting side. We generate profits very quickly, right? So how do we do that, right? We pre-sell inventory. So if we enter into a deal with the landlord, let's say we're sitting here in December, we're going to take occupancy January 15th, February 1st, right? It's not, you don't sign it and take it today. There's a process to hand over the keys. You've got, incumbent operator already there. They've got to work out an exit and an entrance program. And so we set that up, the date up in advance. We are starting to sell that inventory today, even though it's 2-3 weeks away, right? So we're working on selling that inventory. Of course, when you're selling the entire inventory in advance, you're going to be reducing rates, but that's fine, right? You reduce rates to fill occupancy, and then you start building that up over time. So, is there a transition period? Yeah, probably a month or 2, maybe 3, on where the economics aren't as robust, but they're not. It's not that it's not making money. It's just not making as much money. And then inherently, the lease, there's provisions in the lease, depending on the negotiation, could be free rent, could be reduced rent, and then tiered up. So there's things that are structurally done to help us, through that pay period as well. Again, when you're dealing with a heavy management-owned business, as well as one that was, intended to be profitable from day one, philosophy is different, right?
Absolutely. All right. So now we're at that point. Oh, yeah. Sorry.
Yeah, one other thing too that I think that's sort of lost in translation, right, associated to the nature of your question is, so we're not managing to a brand, we're managing to economics, right? So when we acquire property, there it looks and feels like the existing owner's property. There's nothing wrong with Marriott flagged the Herald Square. It looks like a Marriott, right? I've stayed at Marriott's most of my career, have very high level of status there. But when you go into the property, it still looks like a Marriott. There's nothing wrong with the way it looks. We're not in the business of, creating a look and feel that's a LuxUrban look and feel, that you're going to see, you know, the same shade of blue and the same type of carpet in every property, and that's the experience you want. That's very expensive, and it's very hard to make a return on that, right? But there's nothing wrong with looking like a Marriott. There's nothing wrong with looking like a, you know, the former W, which is, you know, the property we have in downtown New York. And we've got one that's a former Renaissance. There's nothing wrong with looking like that. That's a Renaissance is part of the Marriott brand. And so with regard to our operations and how we're able to generate cash flow, as well as, you know, immediate cash flow, as well as just, you know, thinking about, barriers to entry, you know, we've got a philosophy, and we've got the ability to sell that, right? Makes it slightly different from someone who's developing a brand that's very specific to a type of individual, millennial, that's, you know, looking for look and feel, and maybe a bar at the bottom that, you know, provides a vibe. We're not into that, right? So we're into making money economically on the asset. And, you know, I think we have, you know, there's a whole slew of guests that want the same thing, right? They want the best quality product for an economical rate.
Absolutely. So you actually hit on my next question that I'd love asking everybody on here as well. You know, even after doing, you know, having a half-hour one-on-one meeting with a, you know, potential shareholder, current investor, or, you know, maybe somebody that just saw your presentation for the first time or something like that, you know, what would you say folks still also get confused when they think LuxUrban, and after chatting with you, and even after you're 100% clear, you know, but still might get confused? Maybe we can answer some of those frequently asked questions here.
Yeah. So first off, you know, I think people get caught up with regard to, you know, the acquisition side, right? It's triple net lease. It's entire properties. We're not taking a floor. We're taking the whole building. We may peel off the downstairs restaurant because we're not going to operate it, and that's economical for the landlord to keep it and sublease that out. You know, we're not, you know, great in the subleasing space. That's not our competitive strength. We will, if we, you know, we'll try to do it if it comes with it. But, you know, so we are taking the asset, we're taking control of the asset for a long period of time. I think there's always some questions in and around that, which, you know, what happens with X, what happens with Y, you know, but realistically, in a simplistic form, is we deal with the interior side of the building, the exterior side is the landlord, right? And no, we don't get the upside associated to what happens to that asset value in 20 or 30 years. But when we look at, you know, our ability to grow, you know, we have done the math where, you know, the purchase versus the lease is 10 to 15x more powerful in terms of unit count. So if we're able to purchase 100 units, we'd be able to lease 1,000 to 1,500 units, and that's really the power of the business, right? You know, it's timing we're at now. We're able to get control of it. You wouldn't be able to negotiate these sort of leases pre-COVID. Right. So that's one. The second is, you know, there's always a misnomer on what Windom does. Look, Windom is not an operator, right? By design, right? Some of the other large chains, they actually do operations, but Windom is purely a franchisor, right? They don't own assets, they don't compete with us, and they don't manage, right? So they're very complementary to our business. And it goes back to your question earlier. You know, why does it work, right? It works because, you know, I think at the, you know, our business models are very complementary, as well as at the time we signed the agreement with them. I think, you know, it works really well with where we were in our business life cycle, and allows us to leverage that relationship to continue to grow, right? And maybe 5 years from now, you know, we'll be more attractive to somebody else, but, you know, we're already a Windom franchisee, and there's really not terrible opportunity to do that. And then the third is on the hotel operations. I think I've spent some time on it, but we don't hand it off, right? We have experimented with professional managers, and you know we figured out fairly quickly that we manage much better than them. And you know, you sort of say, well, why is that the case? How is that possible? Well, the reality of the professional managers is that they're not motivated to make the most amount of money for you, right? Their incentive structure is they get such a small percentage of that increase in terms of profits that they're not motivated to do it. Think about, you know, the concept of selling $1 million real estate, right? If an agent's getting paid 5%, right? If the agent commission, it's 6%, maybe divide by 2, so it's 3% each. So your agent who's listing it is making $30,000 on that listing, of which they got to share some of that with their broker. Maybe they're making 20,000. So if you sold it for 1.1 million, right, that commission now goes up by $6,000, right, which is divided by 2, which is 3,000, which then maybe 1,000 goes to their broker. So they make 20,000 versus 21 or 22,000, but the difference for you as the owner is it's $94,000 incremental. So the risk reward standpoint, they're not motivated to drive that extra price, just like the professional managers. They're more motivated to bring in more revenue for them, which they do by allocating more costs, right? So it's kind of counterintuitive to that. And we've got a number of questions in and around, do you guys, operate? Yeah, we operate. I talk to the GMs, like, in some cases every day. We have operational calls every day. We deal with issues every day, right? We have guests that are not happy, right? We're just like every other service business. You hear from the guests that are not happy. You don't hear the attaboys, right? When everything goes well, right, as much. And so we deal with that very well, considering, we've been doing this for a short period of time.
Very good. And one other question, just playing devil's advocate, of course, again, I asked this to everybody on here, in your opinion, what would you say are some of the, and this is aside from execution risk, right? Like, let's take that out of the equation. That's always a risk, no matter what, what would you say are some of the company's downside risks that maybe people should consider?
Yeah. So, look, a global shutdown like a COVID would be bad for not only us, for everybody. The way that I've explained that is, we have our break-evens across our portfolio around $160 to $170 per unit. So, some math gets us to 167, but it's somewhere in that range. That's assuming we don't do anything, more severe in terms of cuts. Like, if we start cutting staff, we start eliminating, we start shutting down floors to manage, utility usage and so forth, we can drive that down. Now, I'd challenge you across a portfolio as diverse as ours, with as many high quality assets we have that can make money at 160, 170, on a very, very, acute sort of situation. So the way that I would explain that, right, and that would be a bad situation, not just for us, but for a number of things. What happens in those situations is, again, it happened during COVID, is as prices start to plummet, you will have people immediately start leaving the market. The high cost operators have to shut down, right? They can't, unless they're well capitalized, willing to weather the storm, a big percentage of them will start shutting down. And so as the prices continue to drop, we'll see supply come out of the market. And prices will then stabilize, right? And so that's what happened in COVID, and we think that our break even being what we believe is the lowest in the industry will allow us to do that.
Very cool. Hey, you challenged me. I don't know. I challenge accepted, I guess. I don't know. Let me go find someone else that has all that's high quality assets in Mana. I gotta accept the challenge. I gotta go find them. But all jokes aside, yeah. I do appreciate you being open and sharing all of that. Did we miss anything, or was there more you want to say?
Well, one of the things too, what's interesting is look, you can't, the weird thing about where we are now, and you probably felt the same way too. We've had so many once in a lifetime events in the last 20 years of our lifetime, right? We've had 9/11, we've had COVID, we've had the financial crisis, right? I guess some of these superstorms as well. And so there are so many wild cards out there. We always focus on the last wild card, right? Post 9/11, we were all focused on the issues associated to another terrorist attack and so forth. But that's subsided to other issues that have popped up, financial crisis, so on and so forth. But what's happened over these periods, and with the boon of real estate pre-COVID, is we're actually short supply, right, in major markets. And so you think about New York City, for example, Pre-COVID, you had a ton of condo conversions, right? So supply coming down. You're not getting zoned, you're not getting zoning applications for a significant amount of hotels because there's a backlash associated to housing, right? You have still shuttered or bankrupt properties that are still out of the mix that may never come back, right? Some of which are never going to be put back into operations. So think about overall supply pre-COVID levels, coming down, with condo conversions, and then you have this step change associated to shuttered properties, which there's still a number of shuttered properties. We're probably near all-time supply lows. So even in these sort of situations, the marginal properties, that got hit with COVID, they're still shut down, right? They haven't reopened and so forth, right? Or structurally, some of them. And so, with the impact of, first off, I don't think there will be global shutdowns associated to that. I think, people realize that, we can't sustain that, right? The business level can't sustain that. People will not accept that, right? Throughout the world, there'll be different levels of that. But then, we're also in a situation where we're a lot tighter on supply than we were, the first shutdown, right? So a global shutdown issue associated with COVID. So could there be something else that pops up? Absolutely. Have we seen the cycle, enough of the cycle to know that we're by no means in a situation of, making hay. So, the downside is there, but it's not that far down, but the upside is pretty high. So I view it, my background is risk finance, and I think that the upside opportunity by far and away exceeds the downside risks.
For sure. And I would say probably one of the main things you probably think about, I don't want to not pretend to like read your mind or anything like that, but it seems like the global, another potential shutdown, that isn't as likely as it is maybe just, the rise and fall of interest in certain cities or regions. Like regional risk probably seems more something that might be top of mind versus like, all right, everything's going to get shut down again. It's like, all right, will people still want to keep going to New York, or will people still, want to keep going to Nashville or something? Like, I'm not saying you have properties there, you might, but yeah. You know what I'm saying?
Yeah, no, I actually, I don't disagree at all. I think,
yeah.
So let's talk about the cities we operate in as well as cities we're thinking about and operating in. So New York, is our greatest concentration. I think New York is going to be a destination city. I don't see it changing. Could it change? Absolutely, but I don't see it. Miami, yes, it's more seasonal. There's some more softness in that market, post-COVID versus pre-COVID. But cyclically that'll change as well. But right now we're probably dealing with more softness there than we've experienced in the past. DC, again, very seasonal. We're in a high quality 3-star property. We're looking at, we think that we want to go up market there. But there's still, significant amount of interest there, even though there's a little bit of seasonality too. LA, if you're in a certain pockets, they're great, but, there's some political issues associated to downtown, homelessness, so on and so forth, that all of California is dealing with. But so you got to be much more opportunistic on, Anaheim or Beverly Hills or so forth, which we're looking at. And then New Orleans, a city that's sort of found itself again post Katrina. Very desirable, very artsy sort of place to go to. Sort of big change in the way things were before. And we're looking, very heavily to expand there as well. So those are the cities. So yeah, I could see, the beauty of the portfolio is if one's down, we know one's going to be up. And so, we manage that way. We manage the assets that way. We've obviously, just like, a large family, we've got, a kid that needs more attention and some that, need no attention, right? So it's sort of the same thing. And, typical with any management team or any parent, we probably spend more time and effort on the kid that needs more attention than we do. It's just sort of human nature, even though, if we spent more time on the heavy producer, we probably, increase our margins, right? And then our expansion cities are Boston, which, again, I think we're very resilient. city, and London, which I think is a very resilient city, and immune to seasonality and immune to other factors that could create some issues. So those are the core cities. We're very aware of what's going on. We have an all hands on deck approach to when something isn't performing. Again, going back to the slow kid, of the family, and so we're spending a lot of time on that. I'm cracking you up on that because there's probably some truth to it. Look, I'm one of three.
I'm not saying that it has anything to do with I'm just like, the analogy's funny.
Well, I'm gonna sidebar, right? Because it's known a little about me. So I'm one of three boys, right? So I always tell the story of I grew up. I was born in Singapore, grew up in Singapore, and myself, my two brothers, we all came to the United States for college, and some of us had my oldest brother's born here. We all had green cards, and my other brothers naturalized. But so it was a natural evolution for that. My dad didn't want us to go to school in Singapore, so we sort of went that route. And so when my oldest brother went to school here, my mom got an apartment and was here for about 2 months, making sure he's acclimated, he's got what he needs. My middle brother, my mom got an apartment, was here for a month. And, when I went to school, I came here with 2 suitcases, landed at DFW airport. My brother was supposed to pick me up. He was late. So, stranded at DFW airport. My parents were like, your brother's going to take care of you. And so, and if you think about, the amount of effort, on the top to the middle to the bottom, and sort of invert, who's needed more and less effort. It's sort of the same case, right? Probably put more effort. My oldest brother probably, if they would put more effort, and one of the other two would have been better off, more fruitful. But it's not how parents operate and how people run businesses.
Give yourself a little bit of credit, okay? I think you turned out okay, despite the third child syndrome, So, okay. So to close this out here, and you've given so much of your time here today, and you answer all my questions. I really do appreciate that. But my final question for you here today, to close this out, in your opinion, where would you like to see this company, LuxUrban Hotels, in 3 to 5 years? And what would you say are some of the inflection points that'll get you there?
Yeah, so I think 2024 and 2025, we've done a tremendous job of building the business and gaining credibility, notoriety with landlords, Windom, shareholders, so forth, right? So there's just like any other startup, a lot of skepticism in our ability to execute. Do we really have a market? I think we've resolved all those issues. I think people really believe in the business model. And so we're at this point now, and if you think about the next 2 years, it's really about execution, growing the portfolio, growing it, profitably with good deals. We're going to make mistakes. We always will. But the beauty of an all hands on deck management team and a portfolio is we'll minimize that, right? So I think the next 2 years are very focused on that. And after that, if you look at the 3 to 5 year mark, which is the nature of your question, we will be a significant scale by that point, right? We're going to take advantage of the dislocation and the land grab that's in front of us. At some point in time, the deals will be less attractive, right? Which could be that 3 to 5 year mark. And, at that point, we'll grow probably at a lower pace. We'll have a ton of free cash flow that we won't be needing to reinvest in the business. It just gets to a point where we can't add at that pace that we were adding, we're adding now, and we believe we'll be adding over the next, 6 to 12 months. And so, we'll probably return cash to shareholders, right? We'll do some things in that fashion, which, larger, more established companies with, lower growth rates will do. I think we could be a great, acquisition candidate for, a large hotel chain, potentially a Windom, or maybe a private equity firm who's looking to continue to expand the business in a different way, right? So look, we're focused on long-term shareholder value. We think that, we'll have some bumps along the way, like any other stock, we'll move up and down over time. But, we're very bullish about the opportunity. We're very bullish that, in 3 years, we'll be, people look back at us, say, wow, you guys were much smaller, less sophisticated a few years ago.
Very cool. All right, Shanoop, we're there, man. Where can our audience go and find more information to follow along LuxUrban Hotels?
Yeah, obviously, public company, we're very transparent in filings. So the SEC website, you can go to our website, which links to, not only press releases, but our external side of things. And, we're when I say a public company, not public in terms of capital structure, stay at one of our properties, right? Stay, feel free to reach out to me. If we have a better room available for your stay, we'll put you in a better room. We'll take care of you, right? We host thousands of guests a day, and, we get a handful of negative reviews that are unfortunate, but happen when you're dealing with people and things that break and, situations that occur. But we do our best to make sure everybody's taken care of. And I think we've done a phenomenal job to this date.
Very cool, man. Well, Shanoop, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update. And like I said, we're recording this on Thursday, December 28th, 2023. So happy New Year. I'm sure by the time people hear this, it'll already be the New Year, but happy New Year in any case.
Yeah, thank you. Happy New Year to you, too.
Thank you. This podcast is for informational purposes only and is not provided as financial, legal, or any other advice. The information is not investment advice or an offer to buy or sell any securities or make any investment. The views expressed by guest speakers are their own, and any reference to third-party products, services, or information does not constitute an endorsement thereof by SNN or its affiliates. SNN expressly disclaims all liability for any individual's use of the information presented in this podcast.